All right, my friends, here we go. Conceptual framework for financial reporting. We need the information to be useful for decision making. So there are certain fundamental qualitative characteristics. That information has to be both relevant and reliable. Remember, reliable is really faithful representation. So they want to make sure you know the difference between relevance and reliability. So relevance, again, what's relevant to you? We're going to predict and confirm your material value. So information is relevant if it has predictive value. So we want to use the income statement, let's just say. We want to look at the core business. Remember, the income statement is broken into multiple sections. That top third of an income statement, from sales, cost of goods sold, your SG&A, your depreciation, down to your operating income, that's your core business. Very useful for predicting future trends. So that means it has predictive value. We could take today's sales, forecast the future, take today's earnings, forecast the future. But we also want to confirm value. So obviously, if we've made past forecasts, we then want to confirm that what we've forecasted in the past, well, where did we go wrong, or did we get it correct? And remember, we can't look at every little detail. We need information that is technically material. So part of relevance is that we're really going to isolate information that is capable of making a difference in our decision making. So material information would a reasonable investor, let's say, want to know. Now, fundamental qualitative characteristics, that second part is the reliability. It's got to be faithful, like your boyfriend or girlfriend while you're studying for the exam. Hopefully they're being faithful, reliable. If not, we'll get rid of them, but that's okay. So remember the sentence, completely neutral is free from error. So reliability, completely neutral, is free from error. So the information, for it to be useful, has got to be complete. So we need all the primary financial statements. I need the income statement to assess performance. I need the balance sheet to assess both short-term and long-term risk of distress. I need that statement of cash flow, which is going to tie to both the income statement and the balance sheet. It's going to give me an indication of whether or not my income that I'm showing the bottom line from that income statement, is that likely to be reliable. So is there a big difference between the operating cash flow, that growth rate, versus the growth in earnings? We also use this statement of cash flow to help us assess risk. Are we generating enough cash from our core business to pay our bills as they become due? And remember, completeness also includes the footnotes. You got to tell me the methods of accounting you use: LIFO, FIFO, weighted average, straight line, accelerated, your estimates. Now, to be faithful, to be reliable, the information also needs to be neutral. So remember, that means free from bias. So the information is neutral, free from bias. If that sale occurred, whether it was by IBM or by Microsoft, if they're both booking that sale more or less in the same way, then the information is neutral. We don't want it to be biased, where one company would take the same transaction, yet one would book a higher revenue than the other. And obviously, the information is not useful unless it's free from error. Now remember, error doesn't mean it has to be perfect, okay? It just means it's got to be free from material error, okay? So that does not require perfect accuracy. And then we want to enhance those qualitative characteristics. If you guys remember, we want to compare and verify and time to understand. So comparability is part of the enhancing of the relevance and reliability. Remember, we want to use the financial statements to do trend analysis. We want to compare the target company to itself over time. So that's consistency. You can't be switching from LIFO to FIFO, because then the prior year is not going to be comparable to the current year. We don't want to switch from straight line to accelerated depreciation haphazardly. So we need consistency. And then the users of the financial statements also need the information to be comparable. Remember, if I have $1,000 to invest and I need to choose between Microsoft and IBM, and I'm using their financial statements to help determine which company we want to invest in, well, obviously you can't compare the financial statements of two companies unless they're both using the same generally acceptable methods of accounting. If one company's cash basis and the other company's accrual basis, it's not going to be good. And then the information's got to be verifiable. That's what you guys do, the auditors. So an independent observer is going to go out there and say, is this faithfully represented? Is this information reliable? So a lot of that verifiability explains why under US GAAP we prefer assets to be recorded at historical cost for the most part, because cost is verifiable. Whereas fair market value, unless that asset is publicly traded, you ask 10 people the value of a building in New York City, you're likely to get 10 different estimates. So US GAAP focuses in on the historical cost. It may be less relevant, but it's a hell of a lot more reliable because we have an invoice to support that amount. And then remember, if you're buying and selling stocks or lending money, I can't have financial statements just once a year. We need it generally quarterly. It's got to be timely. This way it makes it useful for making decisions. And then lastly, that information, it better be understandable. If I can't understand it, if it's not clear and concise, I'm not going to be able to use it to make decisions. And always remember, the benefit has to outweigh the cost. It's very expensive to accumulate this information and report it. That's why we can't do audits quarterly. The financial statements are audited annually, but to emphasize timeliness, we're going to have those financial statements reported, the results reported quarterly. Benefit has to outweigh the cost. That's a major constraint. All right, baby. With that review, we're ready. Are you ready? I'm ready. Let's do it.